myself in 2024, I was going to start just creating more content around day trading. I know people be in my inbox asking me questions about it. And there's only so much I can, what I'm saying, explain through a DM. So here I am with this quick generic video on how to trade, right? I trade futures, so that's something a little different. And I trade stock options. So this is what I'm gonna focus on. Um, Here, probably in the near future, I'm gonna create that video about trading futures. But like I said, we just gonna stick to trading options. I think options is a little bit more popular with beginners because basically you buying and selling options or contracts in U.S. companies, right? So we like familiar with Apple, Tesla, Microsoft, companies like that. You can buy and sell their stocks. So this we're gonna stick with this. Keep it very very simple, very elementary, very basic. All right. Now to make money in the stock market, right? What's how you make money in the stock market, right? So you basically bet. You can bet that the stock can go up and you can bet that the stock can go down, right? Now, depending on your thesis, your technical analysis will determine the type of contract that you purchase. When you bet that the stock is going up, you will purchase a call option, right? A call option. And if you believe that the stock is going down, you will buy a put option. Now, how do you make money with that, right? A call is you're buying low and you're selling high. Simple. Buying low, sell high. That's a call option. A put contract is you're selling high, but you're buying it back low. You're selling it high and you're buying it back low because you believe that the stock price is going down. And the position that you put yourself in will determine, what I'm saying, how much money you make, right? So we're gonna go into Apple real quick because we all got iPhones. Most of us got iPhones. So this is what we're looking at real quick. I know you see all these numbers, but please don't be intimidated by all this. Right? Some of this stuff is very important, like right, like the delta, gamma, and theta. These are called your Greeks. These are very important, especially if you're like a swing trader. So the more time that you purchase, the more time that you need to execute your contract will determine how much this affects your contract. Me, I like to day trade. So I like to get into the market the same day and get out the same day. I don't like to hold contracts for a long period of time. So this right here, the Greeks don't affect me as much as it would somebody who purchased contracts a year out. So what we're looking at is a strike, right? So strikes, you see, they kind of like line up on a weekly basis. So basically, every Friday you have contracts that expire, right? So you see 3 days, 10 days, 17 days, 24 days. The farther out you go, the more expensive that contract will be. I'm gonna show you real quick. I'm looking at calls right now. Right now, Apple, the stock market is closed right now, but so Apple closed at 185.64. So say I believe by tomorrow or by Friday that the stock will continue to go up, right? The farther out of the money, the cheaper it is. The closer to the price, the more expensive it is. So, like I said, Apple closed at 185. The farther you go from 185, the cheaper that contract is, but it also the Greeks is different as well. So that's something you got to like learn how to balance in there is the Greeks. But the closer you are to the actual price, the more expensive it's going to be. Now you see 0.75, that's not 75 cents, that's $75. You got to move the decimal over. I don't know why they put it like that. I believe it's because when you do purchase a contract, it's basically you buying like basically like the right to 100 shares. So that's why it shows in the decimals, right? Because you're buying access to 100 shares per contract. So one contract is worth 100 shares. So you're basically having the ability to move around 100 shares with one contract. So we're looking at time, like I said. So for that contract that expires Friday, a 190 strike price will be $26. Now, if you go to the 19th, that same contract now is $132. right? You see the difference because you giving yourself more time for that strategy to play out. I'm gonna go into this. This just shows like if I was to get into a position, this is my single strategy, which is a simple buy or call. I mean, yeah, a buy or sell. My symbol is Apple. This is my strike price, my expiration date. Call or put. You're buying. You can you can adjust your quantity to what you can afford. Your order. This is kind of like how do you enter the market, and we'll go over this later. You can enter with a limit order, market order, stop order. Um, just depending on your strategy will kind of determine how you get into the market, right? Um, yeah, so this is basically what we do, man. We buy puts and we buy calls, right? And that's basically like the foundation to what I do. So yeah, hope this video was informative and educational. So real quick, I'm just sharing with y'all a screenshot from today. This is the first position I got in this morning. So this was like by like 9 o'clock or maybe even before then. It shows the position I was in. I was in the XPX 4735 put that expired today. So I didn't have no more time. Like I had to execute this contract by today, or it would have been worthless. You can see how much I was up. You can see the percentage, right? I paid $510 for the contract, and at the time it got up to $860. And so that's an increase of 68%. You see, I had one. See the average price, the mid price, all that. And yeah, so I'm gonna continue to upload stuff like this, man, and keep y'all informed.